Margin trading, also known as financial leverage, is a very common mechanism in the world of finance. To explain it, we can start with the definition of leverage, which means to lift something with the help of a lever. In finance, it means practically the same thing. It consists of carrying out an operation with your own funds and credit from a third party who would play the role of the lever. In this way, by investing more capital, you can obtain a greater amount of profitability on your operations. For example, let's suppose we want to buy shares of a company and we have $10. The shares are priced at $1 per share. In other words, we could buy 10 shares. We decide to do so and we buy 10 shares at $1. A month goes by and the shares of this company are at $1.50 per share. We then decide to sell our 10 shares at $1.15. In the end, we make a profit of $5, that is 50%. Now, what would happen with leverage? Instead of having $10, we borrow another $40 and buy 50 shares at $1. Time passes and the value of the shares is back to $1.5 per share. We withdraw them and get $75 for our shares. We subtract the 40 borrowed and in the end we are left with $35 including the initial 10. That means that we obtained a profitability of 250%. However, although leverage can help us to obtain higher profits, it can also mean higher losses, since the money you borrow, you have to return it at the end of your operation, plus an interest charged by the broker or exchanger for lending you the money. Now, what happens if the investment does not turn out well? For example, let's say an investor decides to invest $10 in a mutual fund and uses 2-to-1 leverage, which means that the broker lends the investor another $10 for a total investment of $20. If the value of the mutual fund increases by 10% and is worth $22, the investor would have generated a profit of $2. However, if the value of the mutual fund decreases by 10% and is worth $18, the investor would have lost $2, which is equivalent to 20% of his original $10 investment. It is important to keep in mind that when leverage is used, the potential losses are also magnified, so it is crucial to understand the risks and carefully assess the situation before using it. Follow us to discover more about technology, business, marketing, and finance. Smart Kraken.